All right, let's get started. Good evening, everyone. Thanks for coming. We're very honored to have an amazing guest and to continue this series. So my name is Jeffrey Sanchez-Burks. I'm the faculty director of the Impact Studio, which was this small entity under the large conglomerate Business Plus Impact at the Ross School of Business. And effectively, we're trying to be a hub for anything that can address important issues around campus. And so I see the diversity of the students in the room really reflects sort of the spirit of what we're trying to accomplish. The Impact Studio is literally a physical space in that other building down, but it's also a series of activities like today. And effectively what we do is we try to ask the question, how might we be able to use some of the intellectual capital in the university, with the students, with faculty research, and accelerate that to making a real big difference in the world. And so in the Impact Studio, we have some students who are in that class today, who are in the room today, are tackling issues like how do we deal with student debt, credit issues, water security, and so on. In addition, we're hosting these fireside chats in which we can actually dive into important issues. And this is a really important week, and this is a really important topic, and I hope you'll benefit from this, but also engage in some conversations we have. So let me introduce our speaker. We actually are our host. Adrienne Harris is a professor of practice at the Ford School of Public Policy. Her bio actually we could go 2 hours, so I'm just going to give a couple of highlights, and I'm sure you've read it. A senior research fellow at the Gates Foundation, serves on the board of Financial Health Network. The studio actually collaborated with that to throw a financial inclusion scavenger hunt exercise just a few weeks ago, and that was amazing. And was a special agent to President Obama for economic policy, and of the many things in her portfolio was Fintech. So this seems like an appropriate topic for this. And actually, we're going to do things a little bit different. Rather than just the Impact Studio hosting this, we partnered up with the Finance Club at the Ross School of Business. For those of you not in the business school, there are many clubs to join. Some of them probably more fun or more club-like, but Gabby Alves here is one of our star MBA 2s who did an internship where she's going to be taking her next job at some investment firm on the East Coast that some may have heard of. And so together we'll be asking questions. Would you like to share some more about the club and you?
Yeah, sure. So Gabrielle Alves, second year MBA here at Ross. I am the Vice President of Diversity and Inclusion for the Finance Club. And the Finance Club, we predominantly help students recruit and prepare for roles within investment banking and corporate finance. And this is the first year that we're participating in Diversity Week, so super excited to be co-hosting this event today.
Good, fantastic. Shall we get started? Yeah. All right, so the question I have is pretty low-hanging fruit is, what is this fintech? Is it just technology with computers, which has existed for a long time? And in particular, what is financial inclusion, and where do the Venn diagrams of those two things overlap?
Yeah, absolutely. Does everybody hear me okay? No.
Maybe,
Let's see. Does it help if you turn it on?
Maybe? There we go. There we go. All right. Well, thanks all for coming. I know it was the food that brought you, but that's okay. So what is FinTech? We talk about this. I teach 2 classes over at the Ford School. One is called FinTech Entrepreneurship, and the other is Intro to FinTech and the Future of Financial Services. It's a cross-disciplinary set of courses, so I've got lots of Ross students in the classes as well. So FinTech, like everything that gets teched now, right, it's the combination of the traditional industry and how it's been disrupted by tech. But I think, you sort of rightly know.
Don't worry, I'll tell you the volume.
Okay, that it's not new, right? ATM is a combination of tech and finance, right? And those have been around since the 70s. So usually when we're talking about FinTech, we are generally talking about newer technologies that make financial services more efficient, faster, cheaper, more transparent, more user-friendly, right? The same way we talk about tech and the way it blends with any industry. The Venn diagram with financial inclusion, which for those who don't know, typically we define financial inclusion as having access to a traditional financial services institution, by which we usually mean a bank account, right? You've got somewhere to store your money, to do some savings, to transact. At some point we start thinking about financial inclusion as, do you have insurance, right? Do you have other products that help with your own financial resilience? In some parts of the world, like the US, right, most of us are financially included, so the discussion has trended more toward talking about financial health, because we realize that just having access to a bank account actually isn't enough to make you financially healthy in your life. But in lots of parts of the world, right, the access is still the threshold question. So the two sort of overlap insofar as fintech has made it easier for people to have access to all kinds of financial products and services. The definition has started to change, the definition of financial inclusion, because I think people have now realized you don't actually need access to a traditional financial institution to be financially included, right? To have access to the products and services that help you build the financial life. You can use all kinds of apps and services, right? If you're in Kenya, it's probably M-Pesa, but even if you're in the US, there's all kinds of fintech innovations that mean you're not really interacting directly with a bank per se.
Can you speak to the progress that you've seen in terms of making society more financially inclusive?
Yeah, I think there's been a tremendous amount of progress, and again, it depends on sort of where you are in the world, and even within the US, depends on where you are geographically to some extent, and certainly socioeconomically. I think we've realized how important it is to have a formal financial life, whether we're talking about identity, savings, insurance, all kinds of things. I really think it was students who brought this issue to the forefront because everybody was talking about student loans, and we started to see how student loan debt was coming close to housing debt, which I think people thought would never be possible. You guys are all like, it's possible. So we started talking about inclusion in health much more. I think, as a result of the financial crisis, as a result of student loan, but it's a really sort of interesting combination of factors that happen. So you have like the early 2000s or mid 2000s where you get sort of the iPhone and Facebook and all those kind of things, 2004, 5, 6. Then you have the crisis in 2008. And people are like these banks, these financial institutions, it's all a bunch of crooks, like they don't work for me, blah, blah, blah. At the same time, you've got all this tech and this mobile technology happening, and it's just like this really interesting confluence of circumstances that produce fintech. And now people start talking very differently about access to financial institutions, to different kinds of tools that can help them lead financially healthy lives. Interestingly, parts of the world that don't have a sophisticated financial system like the US does, in some ways have made much more progress than the US. And I think of it, like if you're trying to lose weight, right, in some ways it's easier to lose the first 30 pounds than it is to lose like the last 2 pounds. And I think that's sort of where we are as a global society, right? People, those countries and geographies that had more progress to make, right, that were further from being fully financially included, have made much more progress than the US, where most of us are financially included, and there's just a small slice of the population that doesn't have access to services. So it's been interesting to watch that, but you see places like India where they're using biometric identification. Now there's some controversy around that, right? But in the US, it's like you still get this little plastic or like paper social security card, right? Your identity is proven by a state ID, usually a driver's license, which is a thing that kids have been faking and since like the beginning of the time, but we still think that that's the arbiter of your identity. None of you guys. I definitely did it. But we still think of that as ID, but lots of other places in the world, they think about this in a much more sophisticated way. So it's been interesting to watch those who had more progress to make actually sort of leapfrog the US in a lot of ways.
And on that note, what do you think are the major roadblocks for the US to like get to the next level?
Yeah, there's a lot. In some ways, I hate to be sort of a Debbie Downer on the US. When I worked for the president, I would, I'd go overseas and I'd be talking about financial services and financial inclusion, and I'd go to all kinds of other countries and they'd be like, tell us why the US is terrible. And I was like, well, I think I'd get fired if I did that. I don't want to do that. But one of the things, we have a really robust financial system in the US, right? And even compared to places like the UK. So in the US, does anybody know how many financial institutions or banks there are in the US? Rough guess. Close? It would be like The Price is Right, closest without going over. You guys are too young to remember The Price is Right. Okay. It's like a little over 10,000 financial institutions in the US. About 6,000 or 6,500 of them are banks. You know how many banks the UK has? Anybody?
20.
So we have a very robust and competitive financial system in the U.S. We also have an alphabet soup of regulators. So the UK, right, they have 4 banks. They've got like 2.5 financial regulators, or depending on how you count. We've got 8 federal financial regulators, 50 state banking regulators, 50 state insurance regulators, right? And if you're a tech company and you're basically defined by being borderless, that's a problem, right? It's really hard to comply with all those rules. The other thing is, depending on who you talk to, and I promise not to like do any political editorializing, right? But like the banks, like a lot of big corporations, have a lot of lobbying power in the U.S. in ways that doesn't exist in other parts of the world. And I think sometimes that's a good thing, and they use their powers for good, and sometimes not.
Yeah. One of the interesting things about you is that you've held multiple hats that usually people have only held 1 or 2, from the C-suite to being an investor and nonprofit. So with that sort of unique lens or set of lenses, are there any sort of things that you see that you feel are blind spots for others who are only looking at it through one of the other lenses?
Yeah, absolutely. I mean, people sort of joke about my bio a lot. I mostly just say I have a pretty short attention span. I started my career, I'm a JD MBA, started my career in big law in New York. I did mostly derivatives work, was always really politically active, then went to the Obama Treasury Department and then to the White House where I ran the financial services portfolio, and then went to San Francisco when the administration ended and started an insurtech, again, this combination of traditional industry and tech. Started an insurtech company that used machine learning to underwrite title insurance. It's now the 6th largest title insurance company in the country. So by the time it got to be a big company, it was like less fun. The startup phase was really fun. The big company thing was less fun. And then I came here, which is a lot of fun. But what I would say is I have found it really important in my career to see those different perspectives. So when I was practicing law in New York and defending big financial institutions and sort of engaging in regulatory battles on their behalf, I was like, God, these regulators don't know what they're talking about. Like, they don't understand how this business works. Like, they're just making our lives hard for no good reason, right? And then I went to government and I was like, oh, right? Like, they actually do get it, right? This job is actually a little bit harder than the other one. You're dealing with so many constituencies. And then I would have some of my colleagues in the White House, we'd be talking about policies that we wanted to put in place, and somebody would come up with an idea, and I'd say, well, that's not going to work because the banks are just going to X, right? And people would say, well, how do you know that? And I'd say, because that's what I would have advised them to do if they were my client and I was still in the law firm. And then I got a whole other set of experiences, right, being a startup and working with incumbent financial institutions. But I will say there's like this very old article by the Harvard Business Review called The Tri-Sector Athlete, which I've always regarded as such an important article, which basically says like the hardest problems to solve are ones that require people to have perspective from different sectors. And that was sort of how I thought about my careers. I really wanted to be credible in financial services, sort of in the Wall Street sense. I wanted to be credible in the policy community. I wanted to be credible in the tech community, and so I needed to have experience in all those places and speak those languages and understand those cultures to be able to bring them together and solve really thorny problems in the space.
Yeah.
And in terms of like working with all these different stakeholders, how do you go about getting everyone on the same page and kind of moving towards like one solution?
It's hard. I'm trying to remember who was it originally told me this. They didn't coin the phrase, but it's basically you're always looking for like the least bad answer. Because with so many stakeholders, and this is true if you're a policymaker, if you're in business, with so many stakeholders, you're never going to make everybody happy. Like, no, right? And you guys know this. You guys taken negotiations classes or whatever. Like, nobody ever walks away from a good negotiation and everybody's thrilled with the outcome. It rarely happens. Everybody should be smarting just a little bit after they come away from the table. Government, I would say, was particularly hard because there are so many stakeholders. And so you really are just looking for the least bad outcome. You're moving very fast. You have a lot of stakeholders. The stakes are incredibly high. So the only thing you can do, in some ways, at least in policy, is like you're really trying to find your North Star, which is, really should be the American public. Should be, used to be. Sorry, I said I wouldn't editorialize. I'll stop there. And so that's what you're trying to do, but you really do have to hear everybody out and realize, like, for the most part, people are advocating for their positions and coming from a good place, right? And they are trying to do the best they can for their constituency. And usually you don't have a lot of bad actors, so you really are trying to take all the points of view into consideration and come up with the best possible outcome that, in the case of policymakers, serves the American people. In the case of business, right, serves your customers and your shareholders and hopefully your employees. But the only way to do that is really to listen to people with an open mind and an open heart and be honest about how you're coming to your answers.
You mentioned regulators. So what sorts of things should we be really scared about, or what sort of things should regulators have on their mind? In particular, thinking about financial inclusion, like how are there ways in which they can nudge, or there?
Yeah, this is a tricky question, right? So the way we tend to regulate financial services in most industries in the United States is, and I always took a little bit of an issue with this, it's sort of like the list of no-nos, right? And otherwise it's like, go forth, free market, but like, here are the list of no-nos, and then when somebody finds a new no-no, you're like, okay, we'll add that to the list of no-nos. Instead of what I always thought was a better approach, which is like, what's the outcome you're looking to drive, right? Is it financial inclusion, financial health, consumer protection, whatever it is, and like, how do you work toward the affirmative outcome that you want? That was sort of the opportunity I saw with fintech, was a remaking of an industry that most people agreed had not been behaving very well. And now, instead of adding to the list of no-nos, like, why don't we think about an affirmative agenda for financial services? How do we want it to serve the public? How do we want markets to work? But you also want regulators, you don't want them front-running industry, right? You don't want them getting so far out ahead of technological innovation, market innovations, that they're stifling it. And so the trick as a regulator, as a policymaker, is how do you stay close enough to industry to help drive an affirmative agenda, to catch the no-nos when they happen, but not stifle innovation? And it's a really hard balance to strike. So often what happens is regulators end up falling really far behind, right? In an effort not to front run, they fall really far behind, and then the no-nos happen, or they can't really set an affirmative agenda. I think they're getting better at it, especially because of fintech and the financial crisis. But they're just never going to be up there with industry thinking about new and creative things. It's not their job. So now regulators, especially in the financial space, are thinking a lot about AI. How does it work? What does it mean for discrimination? What does it mean for outcomes? They're thinking some, although I think they should be thinking more about cloud computing in financial services and what that means. They're still thinking, in some ways they're using the old framework of financial services and applying it to tech, which I think is not a great approach, but we're so used to thinking about financial services in the predatory sense that then they come to fintech and they're like, okay, well, like, where's the hidden fee? And where's the icky thing? Instead of approaching it again with this affirmative mindset. But it's a work in progress, and I think regulators are getting better at that. There are examples of other regulators around the world that I think do this very, very well. The Monetary Authority of Singapore works very closely with industry to regulate. The Bank of England and the Financial Conduct Authority in the UK work very well with industry. I think the US will get there. It's just that we have a much more complicated regulatory system, and so it's harder.
Mm-hmm. You talked about how a lot of traditional financial institutions may be seen as like predatory, and I'm interested to hear about how you can go about building trust among especially underserved populations in order to like trust these institutions, and also technology on top of that, given like privacy concerns and things of that sort.
Yeah, it's really hard, right? And you talk to people who don't trust their bank, and we see all these scandals. My students have heard this, but I was working for President Obama when the Wells Fargo scandal broke, and I immediately got summoned to the Oval Office to explain like what had happened with Wells Fargo, which was one of like the more terrifying moments of my life. As I tell people, I'm like, the president had like a look on his face, and the only thing I was thinking in my head, but of course did not say out loud, was like, it wasn't me, like I didn't do it. I'm just here to explain to you, anyway. I'm still a little shell-shocked from the experience. The funny thing is, right, like banks behave badly, right? Lots of big companies do, stuff happens. And so there's a lack of trust there with a lot of consumers. But at the same time, then you think about fintech startups, and I think for a lot of people, including historically excluded populations, you're like, yeah, but this could be like two guys in their garage in San Francisco. Like, I may not love Wells Fargo or JP Morgan or Bank of America, but like I know they're going to be around, right? Versus this app that like popped up in my app store today and has like 2 ratings, and I don't know you people, right? So I think it really is hard to build trust in financial services, and finance and money is like one of the most personal things in everybody's life, right? It's emotional, it's personal, it's stressful, right? It's all of these things, and we're basically expected to hand it over, whether it's the money itself or it's our login username and password that's like the key to all of our money, or decision making, right? So the trust issue is a big one. When fintech first came along, they were like, we're not the big financial institutions. You can trust us. We're transparent. We're cheaper. All of that stuff. But that also used to be the case sort of like with Google and Facebook. So we see how this changes, right? Things that start off feeling trustworthy become less so over time, at least in our perceptions. So I think it remains to be seen. But you also, the same way we've always talked about financial literacy and do people understand the financial decisions they're making, there's also a lot about digital literacy, right? Do people understand that when you give your username and password to an app, how much access they have to your data and what they're doing with that data, right? And what, we talk about this in my classes all the time, like what actually is financial data? Before fintech, financial data was just like your transactions data, right? You swiped your Amex at Walgreens, right? Walgreens knows what you bought, Amex doesn't, you do, right? There's like certain kinds of financial information, but now everything is financial information. Hopefully some of my students are nodding. They're like, yes, we know this now. Right? Like you take Uber or Lyft, where you went and at what time is now tied up with a financial service, right? It's a payments app, right? Everything now has become financial data, and everything has become data on which financial decisions about you can be made, and I'm not sure people really have fully grasped that idea yet.
So we talked about one angle of how to have an affirmative agenda from a regulatory perspective. We have a lot of entrepreneurs, people who could be entrepreneurs, thinking about how am I to design ways to address financial inclusion issues, not from a regulatory perspective, but from an entrepreneurial perspective.
Yeah.
What are some of your thoughts on that?
It's challenging, and this is what people will say. Like, people will say it's hard to bank the underbanked or the unbanked, which is typically how we describe those populations, even though bank now, right, is a bit of a misnomer because you don't really need a bank. But we still call them underbanked and unbanked. Historically, people have said it's too costly to serve those populations because they don't create enough revenue for the institution, right? So we have all this regulatory stuff that we have to do, including what we call AML and KYC checks, right? Anti-money laundering, know your customer checks. So like, I have to know that Jeff is Jeff before I give him a bank account, because otherwise the government will be upset with me. So typically what people have said is, the cost of that kind of compliance may not be worth the revenue I get from somebody who's part of one of these underserved, or what we call LMI, low and moderate income populations. Fintech sort of came about with the promise of, we're going to use tech to drive down the cost, and therefore that ratio will be more in whack and we'll be better able to serve these people. So far, it's like, jury's out, at least in the US, right? As I said, in lots of other parts of the world, right, they've tied finance much more into their mobile phones than even we have in the US, and I think they've done a much better job. In the US, fintech is still largely reliant on the traditional system. So how many of you use Venmo? You all use Venmo, right? You still need a bank account or a credit card or something, right? A traditional financial service provider on the back of that. Same with PayPal, which is Venmo's owner. Same with most fintechs. So we've made some progress both on the trust scale and on the access scale, but I don't think fintech has broken it wide open the way they thought they were going to in 2008. So for the entrepreneurs, I still think there's a lot of room, folks in Silicon Valley say, like a lot of dry powder, to figure out, right, how you bring the cost down enough so that you can serve those populations, and ways to engender trust, because it's not only the cost of serving some of these populations, but it's also like, how do you build trust with them and convince them, right, that they should trust you with their money.
And do you think that it's realistic in the near-term future for a lot of these startups to be able to function more independently from traditional financial institutions?
So it's starting to happen. Actually, I guess it was just yesterday, a bank called Varo Bank. How many of you have heard of Varo? Anybody? No. See, Ryan has. Ryan's one of my RAs. It's cheating, although he probably knew it before. Varo is a digitally native bank. They've been trying to get a national banking charter, so you need a charter to be a bank in the US. You can either get a state charter and just operate in the states where you have a charter, or you can get a national charter from the OCC, which is an office of the Treasury Department. The OCC hasn't given a new charter in forever. Varo, which is a digitally native bank, just got approval from the FDIC, the people who provide insurance for your deposits, to get that piece of the charter done. So it's largely expected that they will become the first digitally native bank to get a national banking charter. It's taken them 3 years and over $10 million to do it so far. So they will, in some sense, be a traditional financial institution in the sense that they're licensed just like Citibank and just like other banks, but they'll be digitally native and operate, I think, much differently. But it's taken a lot of time. So there's hope that there will be sort of some separation between the two, but it's a slow process.
We had some students thinking about part of the bottleneck for people who are underbanked is having access to credit, their credit invisibles.
Yeah.
And with a sort of a strange non-regulatory cabal on FICO scores and the big three, is there any way to innovate in that space or to come up with alternatives so that you can get what you need done without necessarily having access to FICO scores?
Yeah, this is a huge debate. So you have people with bad credit, right, low FICO scores, and you have thin file borrowers, which are people who are actually very creditworthy but just don't have usually any credit score, right? So there's these set of thin file people. Sometimes they're foreign nationals who have come to the U.S., right, and they're great credit risk, but nobody understands their credit score from the country they came from. It doesn't translate to FICO. There's now a fintech called Nova Credit that helps with that translation. Or it's people who maybe pay all their bills in cash or with money orders, and they don't have a mortgage and they don't use credit cards, which actually makes them a very good credit risk, but they don't have a FICO score or they don't have a good FICO score, and so people won't lend to them. A couple of things have started happening in that space. One is the use of alternative data. So aside from the factors that FICO looks at to determine your creditworthiness, people are coming up with new algorithms to determine your credit risk. It's a little bit of a double-edged sword, right? In China, they have the social score, so they're like, who are your friends? And how much do they actually like you? And that determines your creditworthiness. In the U.S., we've started looking at all kinds of other data, including where you go to school and what kind of degree you get, and in some ways that's a good thing because it'll probably expand access to credit, but from a privacy perspective, right, it can be a little bit creepy. But that's one of the innovations that's happening. Another innovation that's happening is cash flow underwriting, right? So really just looking at do you have more coming in than you have going out on a regular basis, and what kind of credit risk does that make you? So there's a company called Petal, which is a credit card company that instead of using FICO uses cash flow underwriting. So you give them access to your bank account so they can sort of see the inflows and outflows, and they decide how good a credit risk you are. So there are some interesting innovations happening in that space. I think the big debate now is, people generally agree that you should have access to credit more broadly, right? People should be able to get mortgages and get an auto loan and do all these things they need to do to conduct their lives. But if the cost of that credit goes up too much, what is the trade-off between access and cost? And fintech is still new enough that nobody has really yet studied that trade-off. So people are starting to measure, is fintech cheap? Does fintech make credit cheaper or more expensive? Does fintech increase access to credit or not? They haven't yet put these two things together to say, yes, they've increased access, but they've made it way more expensive. Yes, they've increased access, and it's only become marginally more expensive, and nobody's really decided how they feel about that balance.
Earlier, you talked about this transition from focusing on financial inclusion and moving towards financial health.
Yeah.
Could you speak a little bit more to kind of what financial health looks like and how startups are working towards that goal?
Yeah, absolutely. So for folks who are sort of new to the financial health space, I'll put in my plug for the Financial Health Network where I sit on the board. People will generally define financial health as having savings, having no debt or low debt or good debt, right, which we generally define as like mortgages and student loans and not revolving credit card debt, and resiliency, which is defined sort of as insurance in the traditional sense, or your ability to survive a shock. So your like car breaks down, or your water heater breaks, can you pay for those things and still pay your bills the next month? We are still learning a lot about financial health, and I think even those factors are a fairly new articulation of what it means to be financially healthy. Again, I think prompted by the financial crisis and by the student lending epidemic. So fintechs, I think, have said, okay, well, how do we help people do this? And in large part, they've said, like, how do we use what we know about people's behaviors to help them make better financial decisions? So I'm sure a number of you have taken some sort of behavioral economics class. So we know that things like defaults are important. So there are apps like Digit, where you give them your account login, and they look at your inflows and outflows, and they decide like how much they can take from your checking account every few days and put in a separate savings account that you still have access to, right? But like without you having to think about savings, like they'll do it for you. There's a company called EarnUp that helps people prioritize their debt. So you've all heard, right, you're supposed to pay your most expensive debt off first and then sort of work your way down the ladder. But like that's hard and confusing, and how do I know how much to put to the credit card versus the student loan on any given day? So EarnUp is a company that helps you automatically just prioritize your debt payments and all that. So there's lots of amazing companies out there that are helping with people's financial health. Policy Genius is basically an insurance agency. You go in and you're like, I think I need some life insurance, I think I need auto insurance, I need whatever, right? And they'll help you find the lowest cost provider given your needs. So I think people are really doing this a lot, and I think as fintech started to do this more, then employers started to say, hey, this is something we can offer. So as you are all getting ready to enter the workforce in the next few months, in some cases, or in the next year or so, employers have really decided that this push toward helping their employees be financially healthy is really important. So they're either helping people pay down student loans, right? They're offering financial counseling. They're doing all kinds of things. The other interesting innovation I'll mention, because it's sort of a controversial one, although frankly I'm not sure I understand why, is what we used to call payday advance, right? People tend to think of those as payday lenders, where you go and you get an advance on your pay, and the interest rate is like 400%, right? They're astronomically expensive and predatory. Now with fintech, what's emerged is this idea of like, you only get paid every 2 weeks, in some cases once a month, but usually it's every 2 weeks. But in between those 2 weeks, there's money that you've earned. It's your money, but it's with your employer. And if you could have access to that sooner, you would be better able to withstand financial shocks. And the way we think about it, in a very simple example, is right on day one of the month, you get half of your income, but all of your rent is due, all of your cable is due, right? Like all these things are due in full on the first of the month when you're only getting half your income. And for a substantial portion of the population, their rent or their mortgage payment is exactly equal to half of their income. So now it's like you've paid for a roof over your head, but you can't do anything else. But a couple more days go by, you have to wait 2 weeks for your next paycheck, but what if you could have access to that 2 days of pay, that 3 days of pay, so that you could buy gas, so that you could get a bus ticket, right? All of those things. So there's a lot of companies, Bridget and Earnin, I know the EarnUp was the other one. Earnin is creativity is not a thing that happens that much in the fintech space. Dave, that are helping people get access to their earned but not yet paid wages. And that's another big innovation that I think has really gone a long way to helping people be financially healthier.
I also, when you talked about like Earn-It and those different companies, as soon as you started talking about it, I was like, oh, these are like predatory. So like, how do you kind of change people's like mindset around those types of like institutions?
Yeah, I mean, to be sure, there are a number of good actors in the space, right? Inevitably, there will be some bad actors in the space. So some of it does come back to financial education. I say that with a bit of hesitancy, because I think for a long time, especially in the US, we've relied on financial literacy as the answer, right, to people not being financially healthy. And I always say, like, nobody understands money better than low and moderate income people, right? If you have money, you don't need to understand it as well because you have it. And if you don't have money, like, you actually have a much better understanding of how money works because you have to do that for your survival. But the other issue we've had historically is that we separate financial literacy and I think even digital literacy from the time of decision making. Right, so you're like, I think I might want to buy a house, right? You start like reading about mortgages and how they work and what kind of mortgage you want to get, and like maybe it's another 6 months or longer before you're actually up against this decision making and buying a house. And we all know from your behavioral economics courses what happens between like your present self and your future self, right? Where you're like, I'm not going to eat the French fries, and then you're like, I'm eating the French fries. Or in my case, you're like, I'm not eating the fried Oreos, but then you go to the carnival and you're like, all the fried Oreos. So this idea that like we separate financial education from financial decision making is flawed because the present self and the future self are not the same person. One of the things that Fintech I think can be helpful with is reducing that time so that like you can get not just education, but real data-driven help in making a financial decision based on your very personal situation. A lot of that is AI and machine learning driven. But still the trust barrier persists. And the only way, to help with that is sort of more education. I tend to think, although it sounds a little Pollyanna, is like people talking openly about their finances and the experience we have, but we tend not to do that, again, because it's private and emotional and stressful. People in my class know, like, I talk about my finances all the time. It makes us all very sad, especially me. But like, the only way to help build that trust is to talk about these things and talk about your financial experiences, and then to help people understand the different products. And I think that's a part of the regulator's role as well, is to help people understand the different business models and how they might affect their lives.
Yeah. Are there, so thinking about sort of student debt, and you brought up the issue.
Yeah.
Sensitive topic.
Yeah.
It's actually an important issue. If you think about it, of course, education is one major way of sort of upward mobility for families.
Yeah.
First generation, going to college, different segments of the population. And so it can easily be dismissed as we don't need that.
Mm-hmm.
On the other hand, if you think about this fintech and financial inclusion at the front end, are there things you're seeing in the space that help people either more effectively navigate the debt that we need to take on, or figure out ways to mitigate some of that?
Yeah, I mean, I think it's still largely a tough nut to crack for a couple of reasons. As you guys know, like, most student debt is from the government, right? It's an entitlement, so it's not underwritten, so it's not personalized to your credit risk, to you as a credit risk. That's a bit of a challenge because everybody basically gets the same rate. There are, I mentioned these companies that help you prioritize your debt. There are all kinds of companies that help you understand what it means to pay down additional principal, right, and what that means for your long-term financial view. So there's lots of things coming along. I think the trick is, as you mentioned, right, we tend to think education is the way that it unlocks this great upward mobility. And so yes, you're paying $150,000 for this great education, but you're going to make it back and it's fine, which was true until the financial crisis when people came out of school and couldn't get jobs. And then people were like, oh, maybe there's something off about this equation, right? So I think part of it is now understanding that just because you're well educated doesn't mean you're going to make X amount more money and therefore be able to pay off all of your loans in a couple of years. So I think that's a big part of it. But I think the other thing that people don't realize is it's actually not the majority of student debt is not brought up by people at institutions like this, right? And you guys are like, I disagree, it is. Right, but it tends not to be the elite universities. It tends to be the sort of 2-year, right, dental hygienist, legal assistant, things that cost $90,000, $100,000, right, and those jobs don't produce that kind of income. That's actually the bulk of where student debt comes from. Is it's not going to people who are gonna go and work in amazing financial institutions or great law firms or whatever it is, and then be able to pay off their debt. So it's important to understand that. And then one of the things the CFPB did, the Consumer Financial Protection Bureau, did in the Obama administration was they said, we tried to put in place a couple of things. One was sort of the gainful employment rule, which basically said, like, you can't charge people astronomical prices for education if their financial outcomes don't sort of meet up with that, right? So you can't charge somebody $200,000 for a legal assistant or paralegal degree if you know that the average paralegal makes like $50K, right? It's not okay, you're not allowed to do it. A lot of that has since been rolled back, but we also thought about ways like, how do you put the educational institutions themselves on the hook so that they have a little skin in the game? These are not fintech innovations, they're policy and regulatory innovations. But I think, you know, one of the challenges with fintech is, like, by the time you're coming to some student loan fintech company, you've already got the debt, usually, right? So what we really need are more interventions on the front end to help people think about how much debt compared to their expected income, compared to other life goals they have. And this comes back to this idea of reducing the amount of time between financial education and financial decision making. So just, if I can, like, belabor that example a little bit more, like, you know, I always talk about, like, you've got these little devices that know everything about you. Wouldn't it be great if, right, when you left your job, your phone said, hey, I see you're no longer getting a paycheck from Goldman Sachs, right? Did you leave Goldman Sachs? Like, did you quit your job or leave or whatever? Did you separate from the company? Yes, I did, right? Did you have a 401k there? Yes, I did. Would you like to roll it over? Yes, I would, right? I see that you have these 4 other retirement accounts, including a Fidelity IRA, right? Would you like to roll it over here? Yes. I filled out the paperwork for you. Does all the information in this paper look correct? Yes, it does. Great, it's done, right? Instead of telling you, don't forget, when you leave your job, you have to roll over your 401k, and then life happens, and years go by, and you never roll over your 401k, right? We have to reduce the time between the decision making and the decision, and the same should be true for student loans.